All right, what's going on, guys? Listen up. Terry James, your mortgage guy, coming to you again. Just have a few things of some strategies of what we can do in this market, some things to look at as far as how to address, the interest rates and how we still can move and kind of purchase in this market. So some of the things that people have been looking for, I'm going to give us a couple things, is number one, we have what is a rate buy down. Those are becoming very popular, even 2-1 buy downs, which I'm going to touch on. And then, of course, addressing, ARMs may be another option. What is an ARM? An ARM is an adjustable rate mortgage. So we're going to go over some strategies and some different loan options and different things we can do on how we can kind of, like I said, move in this market with, rates moving up. What do we do? How do we address that? So one of the things is we're talking about, what is a rate buy down? And so a lot of people don't know, exactly what that means, how that comes into play, what exactly is a rate buy down. So one of the things is that essentially a rate buy down is when you use either your own funds or basically even if you get seller credits, which we'll talk about, is where you're able to buy your rate down. So that means by paying a little more on top of your closing costs, it's able to allows you the benefit of being able to lower your interest rate. So to lower your interest rate, what does that mean? What does that look like? So for example, it's called, what in the lending field, what is usually called is oftentimes it's going to be called discount point. It may be origination point. It may be listed under there as just points in general. So what that is that is basically as you pay a point, and let's just break this down. I always like to make things very simple. So for example, what is 1 point? When you go to buy your rate down and you look at, okay, what are the costs? So 1 point, 1% of your loan amount. So if you spend 1 point to buy your rate down, you're spending 1% of your loan amount to get a lower rate. Now, what we have to understand is that 1 point does not give you 1 point in rate. So, for example, if you're looking at 1 point, and let's say that 1 point, and we're just throwing some numbers out there. This isn't, every situation, but let's say 1 point is going to take you down from maybe 7%. Let's say you're at 7%, 1 point. If you pay an extra point, it might take you down maybe a quarter, maybe an eighth of a point. What that means is you might go down from 7% to maybe 6.75% in your interest rate. That's by paying 1 point. Now, it can always vary depending on the loan term, depending on the loan product, depending on, your debt to income ratio, depending on your credit score. There's a lot of factors that can come into play when it comes to how much does 1 point get you. But I just wanted to talk about so that we understand what points mean and how that works. Now, the main thing that we definitely want to understand when it comes to buying points down, and I'm going to go over an example, but the main thing we want to understand is what is your break-even point. So anytime you start to get into the era, and we're in that market right now where, hey, let's buy the rate down, let's get a lower payment. The most important thing when you start looking into that, and when you're going to spend your money to get that down, the most important thing is, what is my break-even point? Okay, so that means that when I spend that 1 point, or when I spend, on points, at what point do I break even? So I'm going to show you what that looks like. Now, for this example, we're going to take a loan amount of $100,000. Okay, and let's say that 1 point, 1% of that is $1,000. And for this example, we're going to say pay no point, you're at 6%. And now we're going to take you down to 5.75%. Now, your payment on $100,000, which is just principal and interest, we're not including taxes and insurance, your payment on $100,000 is at 6%. Your payment's going to be $599.55 versus a payment amount on 5.75%. So let's say that you know that 1 point is going to get your payment down. Just for this example, let's say it gets it down to 5.75%. So now your principal and interest payment is going to be $583.75, which gives you a difference of $15.98. Okay. Now, your break-even point, okay, so now that you pay, there's just a hypothetical, so you pay $1,000 to get your rate down. This is how we're going to calculate your break-even point. So now you're going to take that $1,000 divided by the money that you would save every month, and that's going to give you 62 months. So what that means is your break-even point is going to be 62 months. You know how many months are in a year. Now you're looking at 5 years. So if you spend $1,000 and you save $15 a month, it's going to take you 5 years to break even. Now, why is this break even thing so important when we're looking at points and you know how much money you're spending? So that break even mark is essentially where it's going to be. How long are you going to be in the loan? Now, I always like to tell people, because there's a difference between being in the house versus being in that loan. Because, for example, if your break-even point, like this example, is 5 years, and let's say at the 3-year mark, you decide to go get another loan, or you decide to refinance, okay? Or even sell. But for this purpose, we're going to say, let's say you decide to refinance. If you refinance at the 3-year mark, you've basically wasted $1,000 of your money. So that's why it's important to understand what is the break-even part, and then to understand your situation of, okay, if I spend $1,000, if I spend this money to get the rate down, and my break-even is 5 years, then I intend to keep this loan for that period. Now, we know $15 is not really worth savings, but this is an example of what you look at when you're looking at and discussing buying points, and when you go into buy downs and what a buy down is and how that affects you. The most important part is going to be deciding what is your break even, and then looking at what is your goal. If you're going to refinance, if you're going to sell within 2 years, then obviously spending $1,000 up front may not be beneficial, considering your break-even mark is 5 years out. So those are the things that you have to look at when looking at a rate buy down. Now, what we just went over and what I just went over was going over what a straight buy down option is. So that's just talking with your loan broker and saying, hey, you know, I just want to buy the rate down. Now, one of the things that is becoming very popular nowadays, and which is a lot of people are benefiting, and why you have to look at this option, is called the 2-1 buy down. It's even, they have a 1-0 buy down, they have a 3-2-1 buy down. And so what are these different programs? What do they mean? So for example, a 3-2-1 or even a 2-1 buy down, let's just look at that. So a 2-1 buy down is saying that you pay this amount of dollars, which it all can vary depending on your loan amount, purchase price, and so forth. But what it is that it's usually going to be the savings over a certain period. So for example, a 2-1 buy down. What that means is that your interest rate, if you lock in at an interest rate today, we'll just say 7.5%. What the 2-1 buy down means is that for the first year, you're actually going to be 2% lower than the 7.5%. So that 2% lower is 5.5%. So for the first year of your mortgage payments, your payments are going to be based on a 5.5% interest rate. So that money is going to be saved in your pocket. You're able to kind of save that money. You're able to benefit from a lower interest rate. And then in the meantime, what happens is on a 2-1 buy down is the next year, after the first 12 months, it's going to be 6.5%. After that year, it adjusts back up to the 7.5% that you locked in on. Now, a lot of people say, well, what are the benefits of that? Well, obviously, the benefits is up front for the first year. you are going to have a huge savings going from 7.5% to 5.5%. Second year, you're still going to have a savings, even from 6.5% to 7.5%. You still have that savings. And the goal is, within that time frame, the goal would be that, yes, you are looking to refinance when the rates get lower so that you can lock in on a lower rate. That, of course, is the goal of having a buy down or 2-1 buy down option. Okay? Now, to get into it, what you have to look at and what's going to determine whether or not this is a good option for you is, once again, what is the break-even point? So for a 2-1 buy down, a rough estimate as far as of cost, typically you're going to pay anywhere from at least $12,000, maybe $15,000 to get into one of those buy down options, like a 2-1 buy down, 3-2-1, whatever that is. That's a rough number. So what you want to look at now is that, hey, if you spend $15,000 up front, how much are you going to save monthly before you break even? So once again, you do the math. You look at how much you're spending. You divide up that cost by how much you're going to save every month, and that will give you your break even point. So right there, that's how you determine kind of if it makes sense to do these options. But these are some strategies that will definitely work for you, depending on your situation, depending on what your overall goal is of that property when you get into that home. You know, how fast are you going to refinance? Do you think the market is going to move? Because here's the thing, is that depending on how long you keep that term, when your break-even point is, that's going to be everything right now. One of the options when we start to look at rate buydowns and to see if that makes sense, one of the things you really have to look at is, okay, are we getting seller credits? Because that can change a lot as far as how we're looking at it and if it makes sense. So for example, if you're getting some seller credits, which I have other videos talking about what those are. If you have questions, look through the YouTube channel. But what if you're able to get seller credits, and let's say you get a seller credit of $10,000, $15,000, now you can use that to do or to buy your rate down. That may very well make it worthwhile, because that's not money coming out of your pocket, but that's money coming to you that you can now benefit from and get a lower payment. So now your break even is going to be huge because it's not money out of your pocket. So that's where all these situations, all these factors play a part. I just wanted to kind of bring that to you and kind of share with you different strategies. So, you know, one of the things I even talk to people about is that depending on the situation, everything may not work for every situation in real estate. It all determines on the buyer, the seller. But one of the things to look for is that a lot of people are going around and they're saying, hey, you know, you put an offer in and you're trying to basically say, let me, you know, the seller, you're negotiating. Rather than have the seller reduce the cost of the home, you may want to look at as saying, hey, don't reduce the cost, but can I negotiate a seller credit? So that way there, the seller is still going to get the price, let's just say $600,000. They sell the home for $600,000, but rather than you negotiate and say, hey, lower the price to, you know, we'll say $550 just for example purposes. So rather than lowering that price from, you know, $600,000 to $550,000, why not look at negotiating and saying, hey, can we get a seller credit? Keep the price the same, but let's get a seller credit of $15,000, right? So now the seller is still going to get kind of what they're looking for, you know, if they've agreed to lower the price. But rather than lower it, I would say, no, keep the price the same, and now just give me a seller credit for that amount. So that may be a very good strategy, because now you can use those seller credits to do one of these rate buy down options and save yourself thousands of dollars. So, you know, when the interest rate get high, we have to look for different strategies of how can we save money on the monthly mortgage payment to make it affordable for you. Now, one of the other things that is going on in this market, which, you know, may not be as far as a very popular thing right now. But the other thing you do have to consider is a ARM, which is a adjustable rate mortgage. And so with the ARMs, what that means is that it's going to be your loan is fixed for so many years, and then after, usually ARMs can be anywhere fixed from 1 year, 2, 5, 6, 7, all the way up to 10 years typically, that you can get an adjustable rate mortgage. So what that means is that after that fixed period, your loan will adjust. Now, typically when you get into an ARM product, those rates are going to be a little bit lower than, for instance, like a 30-year fixed option, because your rate's going to adjust later. Now, the reason why some people are looking at that, considering that in this market, is you're saying that, yes, I'm going to take a lower rate now, and then eventually before it adjusts, the plan is that we're going to refinance. And while that is an option, I always want to tell people that you want to, before you do an ARM, you want to make sure you figure out what is my payment going to be once it adjusts. So if you're in a 5-year fixed option and you're looking at that, you're saying, okay, I like the rate, like the payment, that's great. What you want to look at is after 5 years, what does that payment adjust to? And the reason why that's important is because as you're watching the market, let's say the market doesn't move down, and let's say, whatever rate you're at, it doesn't make sense to move into another loan, and 5 years comes and now you're in that adjustable mortgage. The reason why you have to have all the information to see what kind of ARM are you in and to see what is that payment going to adjust to. Now, yes, you can't really dictate what the payment is, because a lot of adjustables are based on the market at that time. So when 5 years come, if you're in a 5-year adjustable ARM, the 5 years come, now you adjust based upon what the market is right at that 5-year period. Now, typically, in most cases, the interest rate or what your rate adjusts to is usually going to be higher. Very seldom does it adjust down. So usually you want to look at, okay, if, based upon the agreement, based upon how my ARM is set up, this is the max that it can adjust to. This is what my mortgage payment is going to be based upon that number. You want to know, well, what if it adjusts and I can't afford the payment? So that's where you want to have all that information, because if you can't afford that payment at that time, that could end up in a not a great situation, because that's what your payment's going to be based on. So now you're going to be forced to really try and refinance at that point, or worst case scenario, selling the property to get out of that loan. So one of the things that you really have to look at is affordability. When you get into the ARM, if you're doing a 2-year adjustable ARM, you want to look at, well, can I afford the payment once it adjusts? Because nobody really knows what the market is going to do in a year, in 2 years from now, 3 years from now. Nobody really knows what the market is going to do. But there's a lot of indicators that people look at. I'm not going to get into that. I won't, predict what's going to happen. I don't have a crystal ball. But at the end of the day, the thing is, when I'm talking about adjustable ARMs, we have to be aware, what that's going to be, and making sure you're aware, is it going to be affordable for you when that loan adjusts? And so it may be a good option depending on what the rate is, depending on your goals. And that's why it's very important that when you get into a home and you're buying a home and you're getting a loan, you and your loan officer need to discuss what your goal is. And so if your loan officer is not asking you, your mortgage broker is not asking you what your overall goal for the property is, and it can change, granted, no doubt, situations happen, things change. But when you're getting into a certain loan product, or you're looking at a rate buy down and you're looking at this buy down option, to really see if it makes sense is really going to determine what are your overall goals of not only the loan, not only the home, but the loan. Because once again, when you get into a loan and let's say you've spent $15,000 to buy down, and yes, you might be in the home for 15 years, but how long do you plan to be in that loan? Because if you're only going to be in the loan for 2 years and your break-even point is 5, you have to reevaluate, is it worth it? So If you have any questions on rate buy down options, if it makes sense, definitely contact me, DM me. But once again, that break even point is very important to look at, and there's some great strategies out there in this market with rates going up. It may be a good option to look at a rate buy down, a 2-1 buy down, or even an adjustable mortgage. All right. So until next time, take care.